The capital market, to me, is the center of it all. It's called the center of capitalism. And you can't really divorce capitalism from democracy. They are two sides of the same coin. So whatever you see in a well-developed environment, in democratic, you find the capitalism side of it. So we're here to talk about policies and practices that disincentivize agribusiness and look at level of inclusion and acceptability that agribusiness folks will want to see from the market. So let me quickly yield to, let's allow ladies to go first, shall we? Yes, let's hear from let's put your hands together for Senami Johnson. Madam, you have the floor. You can speak from where you sit, please.
What are we speaking about? Okay, thank you very much. So I have a slightly different perspective than what has been said so far. First of all, if we use the data from PwC report in 2020, agribusiness actually has 4 different sectors. There is the crop production, there is fishery, there is livestock, and there is forestry. So I'm coming from the fisheries side of things, not the grain side. So this is different. From the fishery side of things, what we do with them is pretty much we try and see how we can put technology in their structure. What we know a lot of fishery business do is they do all the mud ponds. But what we do is to introduce technology into the structure. We fund that, and we also expose them to the international market, which is the export side of the market. We know that we've seen all the data on how we need to improve our exports in agri side, and we know that there is a demand for agri exports in the international market.
The whole idea of this conversation is about fundraising, bringing agribusiness and the markets, the deep end of the market together, where you have the debt, you have the equities, and the rest of them. You're an operator in the agribusiness, so I think this is fairly well balanced in terms of yourself, what you do, and Olam. The other 2 gentlemen here are in investment advisory and the rest of them. So I think this is a good time for all of us to go to the altar where we are right now. So I'll just matchmake and make sure you guys go home very nicely. Everybody's happy, there's a deal, and there's business done. What would you like to see? What are the current trends and that you see that disincentivize investments in the agribusiness sector? And if you look at Olam, in about 60 countries, based in every corner of the world, so I'm sure you have a very good experience in terms of how you raise funds across jurisdictions and what are the best practices that we can bring to bear in the Nigerian space.
So we are very active in the capital markets other than Nigeria. So although Olam started in Nigeria, but never really entered capital markets in Nigeria because it is a little more cumbersome and not as matured as it is in other markets. And it is easier in the other markets to raise funds. So other than that, also I believe that since agricultural industry is, as how the MD of NIRSAL also mentioned initially, that it is a very risky business. It is not a straightforward business. There are a lot of external factors, which makes it difficult for the agri-businesses to enter the agriculture market. And certainly how we discussed in the last session about the rating agencies and for the bonds, to ensure that the risk is minimized, the ratings have to be in line. So that also takes a lot of cost. And sometimes it becomes more expensive to get into capital markets than to go to normal banking channels for raising funds. So those are pretty much the 2 big disincentives per se, that it becomes too costly to enter the capital markets than the normal traditional way of sourcing of finance in Nigeria.
Because again, this hits me very hard when you look at the size of Olam, but not doing a single debt or equity raising in Nigeria so far. Now, what do you think the disincentives are? Because this is just as big as it can get. If you talk about Olam, you're talking like Dangote cement in so many countries.
Thank you, Boason. And good afternoon, everyone. I think the way the capital market works, I like to always say that the rules of the capital market works for everyone. So there are no disincentives to any particular sector or any particular company, group. But the primary thing you must know when you want to come to the capital market is the same thing that operates in Nigeria operates everywhere else. The level of disclosure requirements are the same, so you need to disclose. And also, the regulatory requirements are almost the same with any other markets in the world. What we have in Nigeria that I think favors Nigerian businesses, maybe not at Olam, is the fact that if you do business in Naira, you should fund in Naira. And the Nigerian debt capital market is one of the most sophisticated and one of the biggest in Africa today. And like the gentleman from Pencom said earlier, over the years, we've constantly seen Pencom move what is considered investable asset classes for pension funds, and they've moved it to the extent that pension fund can almost invest in any form of instruments today, as long as it's packaged in a way that it can invest in it. So the decision to come to the capital market at the company level is more a strategic decision as against whether the market is ready. Because what we've got in Nigeria is what they've got everywhere else in terms of disclosure requirements and regulatory requirements. Maybe not depth and sophistication. And again, one of the reasons why the Nigerian market may not have that depth and sophistication is because, as we speak today, the chunk of our investment in our capital market comes from the pension funds, and everyone knows pension is sort of like highly regulated. In other climes, they have a lot of other institutional investors that are well developed and have been able to create a lot more products beyond conventional products. But beyond that, I don't think there are any particular disincentives. What I like to say most of the time is capital market works two ways. So it's either you go to the capital market or the capital market comes to you. So one of the ways the capital market can come to you, everyone is talking about, we saw Balance earlier, and Olam, we talked about Ella Lakes, seasoned large companies that can by themselves go to the capital markets. But what about those that cannot go to the capital market? Can capital market work for them? So the MD of NISA talked about all of the aggregation model that they are looking to do. And yes, capital market can work for everyone. It's whether capital market operators can roll up their sleeves and do the work and build up the competencies to be able to make the capital market go to those places that cannot come to the capital market. And I think that's what we should be discussing, even as we try to see more indigenous companies go to become like the Olam and the Ella Lakes and able to go to the capital market themselves. We should create infrastructures, platforms that allow for the capital markets to go to businesses that will do well by getting funding from the capital market.
So let me ask my friend Kayode Omosebi if you think any of these macroeconomic environment variables and monetary issues around exchange rates, policies, and how these trends can be a disincentive to those who are in agribusiness and who want to approach the marketplace, the capital market, that is.
Okay, thank you. Yeah, the agricultural sector is very attractive, like everyone says, but people shy away from the sector because of risk. And when you talk about risk, you're talking about supply chain, you're talking about transportation, you're talking about storage. Just like one said that the farther you are from the farm, the more money you make. So two things is investors are sort of, they're rational in their decision. So they go to where they can get optimal return at sort of reduced risk. And so two things are important from an agri perspective in terms of how you want to attract capital. You need to be able to show ability to scale, and you need to be able to show ability to mitigate your risk. Now, these two things are quite intertwined in terms of how you fix them. For you to scale, you need to be able to deliver revenues at sort of cost-effective manner. And to do that, you need to be able to integrate your value chain. And so what that means is when you raise financing as an agri player, you need to be able to show that you are integrating well, one, with your technical partners who are like providing seeds for you, storage partners, transport operators, other actors across your value chain. Now, you can be Olam, who is big enough to buy all the players across his value chain. But if you're not on that level, then you need to start looking at joint ventures, consortiums. We've seen this happen in different sectors. The oil sector has done a debt instrument of about 20 years. And this is because that instrument had all chains, supplier of gas, the technical who needs maybe 1,000 metric tons of cassava. There's a processing company to buy this, to raise money, to buy a machine to process cassava. But then it's relying on a farmer who needs to plant that same cassava. And that farmer also needs an input supplier who provide the grains and everything. You can come all together into umbrella, is the funds, is deployed to different parties. And for that, for a financier, it can follow the money from end to end. That reduces the risk and gives you ability to scale. So I think once players start to integrate themselves that way, it breaks a lot of issues when it comes to funding for agri players. That's what I think.